A recent RBI draft norm may lead many banks to rethink their business models. What are these guidelines about? Well, at the heart of them is the regulator's view that core banking activities, that's deposit mobilization and lending, should reside within a bank rather than its subsidiaries. Here's my colleague, ET's banking editor, Sangita Mehta.
So clearly, RBI is not comfortable with the overlap in activities between banks and NBFCs. And what RBI is trying to say is that if a bank can undertake a certain activity, why should bank float a subsidiary to undertake the same activity, such as giving loans or advisory? The bank itself can do it. And think of it from the customer's point of view. Very often they get confused whether they are dealing with the bank or the subsidiary, because they look at it as a same group entity. So what RBI is trying to do is that they're trying to ring fence the core business of a bank from the non-core business of the bank.
If finalized, the rules will affect the way several banks and their units are functioning now. It could also impact valuations in some upcoming bank IPOs. So, what are these draft norms and how exactly will they impact the banking sector? Let's find out. It's Tuesday, the 5th of November. I'm your host, Anirban Chowdhury. This is the Morning Brief. Here's Sachin Gupta, Chief Ratings Officer at CARE Edge.
So, it's clearly a forward-looking planned regulation of RBI. As we speak, it is still a draft circular and it is open for consultation, etc. And subsequent to that, there will be another 2 years given to affected entities to plan it out and then make whatever changes that they're required to do. So broadly, if I were to first say what exactly it's gonna entail, at a very basic level, this draft circular is actually talking about how various businesses are conducted by the banks. So banks, as you know, have lending business. They accept their deposits, and then which is essentially very, very core to bank, and only banks can do that. But then beyond that, there are also other businesses that they do, like a mutual fund or an NBFC or an insurance or broking and etc. And many of these kind of are housed differently in different banks. Some of them may have them as a subsidiary, may of them which could be 100% subsidiary, it could be a part subsidiary, it could even be a division of within the bank itself. So what this circular essentially attempts to do is to clearly streamline and remove any confusions as to how the various financing businesses of a bank should be structured. What can be within a bank as a division, what cannot be within a bank, and therefore it should be a separate legal entity, so that to avoid any unintended overlaps and which kind of cause some risks to the financial systems. A very simple point I can add here is, say, something like evergreening, which is always a threat which a regulator has, that you give loan to one entity and then you keep evergreening it. Now RBI has made it very difficult to evergreen it within that same legal entity. But if you have two legal entities doing the same business, then it becomes relatively easy. So maybe one of the key reasons what RBI is intending to do is, avoid any such evergreening possibilities which the financial system or any financial particular group may be doing.
How do you see it in the light of RBI's overall proactive stance in, taking several steps in the last few months to, make the banking system tighter and also to reduce risks? How do you see it in the light of a stronger and more proactive RBI?
That's a very good question, Anirban. If we see RBI, they have certainly been very proactive in terms of, at multiple levels to reduce the systemic risk. And this seems a little contrasting, especially because the overall financial system, if you see, both banks and NBFC, they are actually doing reasonably well. And, when I look at in terms of what all RBI has been doing, broadly, I will kind of categorize it into three segments. First is in terms of improving the balance sheet strength, or rather consolidating or continuing with the strong balance sheets which the banks and NBFCs have as of now. And in that respect, if you see the upcoming guidelines, there is an ECL, the expected credit loss framework, which is going to be implemented. There's a new project financing circular which is going to be implemented. Also LCR, which is talking about the liquidity and the ALM issues. All these three things, to my mind, are something which the RBI is thinking will help strengthen the bank's balance sheets even further. And if there was any stress, they basically will have more capital to take care of that. So that is the first segment. The second is where we see is the strengthening of the financial system. So some of the changes that you may see, when they are looking at, fintechs, NBFCs relationships, they've taken some actions there. Or the current circular that we're talking about today, these are clearly to basically strengthen the overall financial system. And thirdly, I would say the third category of changes which RBI is doing is, and which is one of the more recent ones they have done, on MFIs, etc., is in terms of from a consumer protection perspective, where they believe that, the NBFCs or MFIs or other entities are unduly charging higher rates of interest, and which indeed can become a long term systemic risk also. So that is something which is, so broadly three segments: strengthening the balance sheets, strengthening the overall financial system, and thirdly the focus on consumer protection. So these, I would say, are the three segments I can, if I were to decode how RBI is behaving, and then within them they are working very hard and coming out with these various circulars and, forward looking guidelines, etc.
Right. Assuming, let's if we assume, and that this will obviously not be the case, I guess, but assuming that these draft is implemented in its current form, how do you see the realignment happening in financial institutions?
So if these guidelines and the way I'm reading it, if I really read it in the spirit of what RBI is trying to do, that certainly will have significant changes. Either then the housing finance business has to be merged into the bank, right? Or that entity has to be sold out. These are the only two things I can think of. And I mean, so in a way, say what HDFC Limited's merger into HDFC Bank, while that was a event which happened and there were maybe other drivers for that, this regulation wasn't there then, but they did that. So something similar may happen for other banks who own HFCs. So that is one. Also, where it will impact, and maybe to some extent the markets, is that many of these subsidiaries were looking at doing their IPOs or raising public equity, and maybe they were looking at monetizing some part of their equity in that, by selling maybe 20-30%, and they get benefit of that. Now with this, I mean, honestly, there is a question mark that if either they can merge the whole business back into the bank or they sell it completely out, then how would this monetization through an IPO business happen? That is, I think, to me, the single biggest immediate effect that it could have on the overall financial markets.
Absolutely, and given the fact that HDB is looking for an IPO, so it becomes very relevant in such cases. Now, Sachin, what impact do you think it will have on banks' balance sheets going forward?
So that's an interesting question. If you see, maybe in top of our mind, there are a few large private sector banks, and they have some large NBFCs, right? And which have kind of gained some meaningful, significant size over the last few years. So for them, yes, it would have an impact. But if you were to look at the overall banking system, and PSU banks being, one big segment of that, they may not have as much subsidiaries. Yes, maybe SBI has, but if I were to look at overall level, there may not be too many large subsidiaries that they have. So from an overall balance sheet size or strength perspective, it may not have much impact. But yes, I would feel that for some of the large private sector banks who have large businesses, subsidiaries, there would be, I would say, there will be some reorganization there. Difficult to say at this point of time that it will be necessarily a negative or a positive impact. And then that is where I think RBI has, even in their draft circular, they are saying they will give 2 years, is because these will require some, material changes. So it allows them time to really plan it out and see what options they have, and accordingly do that.
Thank you so much, Sachin, for your insights. It was absolutely wonderful talking to you.
Great, Anirban. Same here. Really loved interacting with you. Thanks a lot and have a good day.
So, which financial institutions will be impacted by these guidelines? Here's Sangita again.
So, a whole lot of banks would get affected, I would think. HDFC, Kotak Mahindra would be most affected. But then there are others like PNB, Canara, Central Bank, Federal Bank, ICICI Bank, and Axis Bank. Those banks would also be affected. So, for instance, ICICI Bank, PNB, Canara, Central, all of them have a housing finance company as their subsidiary. So bank also gives housing finance and their subsidiaries also give housing finance. Now this kind of an overlap is something which RBI is not comfortable with, and the circular says that either it should be done by the bank or the subsidiary. So one of them will have to give up home loan activity. Similarly, Axis Bank has a subsidiary called Axis Finance, and they also give personal loans, home loans. So those activities again will have to reside with the bank, because RBI has clearly said that lending activity and deposits should reside with the bank.
Understood. Why do you say Kotak and HDFC Bank would be most affected?
So, Anirban, HDFC Bank has a subsidiary HDB Finance, and it's been in the media also. They're looking for an IPO, 12,500 crore, which is recently their board has approved. Now, HDB Finance provides gold loan, two-wheeler loans, and personal loan. And even the parent, HDFC Bank, provides these loans. So clearly there is an overlap over there. And if you go by RBI's draft circular, and if they become the final circular without any changes, then the core lending activity will have to reside with the bank. So I really clearly don't know what activity the subsidiary will do. Probably they may operate as agents or DSA. There could be some activity that they would still do, but what probably could happen, and this is what auditors and bank analysts tell us, is that it could affect the valuation of HDB if they come in without any changes.
Okay. And Sangita, what about Kotak?
So Kotak has multiple subsidiaries, and the businesses of those subsidiaries are overlapping with the parent bank, such as microfinance business, real estate business, loans to properties, finance to retail consumers, and dealers in passenger vehicles. So they will surely have to realign their businesses if these draft guidelines are implemented as it is.
Right. You were also referring to circumventing the norms. Can you elaborate on that?
Yeah, so what is happening right now is that there are certain restrictions on banks which are not applicable to NBFCs. So let me give you an example. A bank cannot provide loan to a builder for acquisition of land. However, an NBFC can do that. So clearly, if you want to retain relationship with the customer, what probably a bank will do is that, hey, I cannot give you this loan, but here is my subsidiary, which is an NBFC. You can take the loan for acquisition of land from them, and I will give you loan for construction of the property. So clearly, the exposure is on the group. And this is something which RBI is not comfortable with, because you're circumventing the guideline by floating this subsidiary. This is just one example. Then there is loan against shares. Now, a bank can give loan to an individual to purchase shares only up to 20 lakhs, whereas an NBFC can, there is a cap, but it's not so low. So clearly, you can circumvent again RBI's guideline by using the subsidiary route to retain that customer. So these are the things that RBI is not comfortable, and probably this is the reason why they've come out with this wider guideline to cover the entire subsidiaries and associates of banks.
Right. Sangita, thank you so much for your insights. It was wonderful to have you as always.
Thank you, Anirban. It was a pleasure to be on the show.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Surohini Jain and sound designed by Amrit Reggie. A new episode of TMB drops every Tuesday, Thursday, and Friday on a listening platform of your choice. Also listen to 7 at 7, that's 7 at the rate 7, our daily news capsule, and ET Wealth and Beyond, our new series with the Bombay Stock Exchange on all things investment. This is your host Anirban Chowdhury signing off. Have a good week ahead.